Question 1. Types of captive insurance. Which of the following best describes the primary purpose of a protected cell in captive insurance? A. It allows for the segregation of risk within a captive insurance company, ensuring that the assets of one cell cannot be used to satisfy the liabilities of another cell. B. It allows multiple unrelated entities to pool their risks together, sharing a common liability pool for cost reduction. C. It is a special form of group captive where participants share ownership and decision-making power. D. It is a type of captive insurance that allows external investors to buy into the captive's equity shares. Answer A. Explanation. A protected cell is a unique structure where each cell within the captive is legally segregated from others, meaning the assets and liabilities of one cell cannot be used to cover the obligations of another cell. This protects each participant from the risks associated with other cells in the same captive. This structure is especially beneficial for entities seeking risk management without the risk of commingling funds. North Carolina Captive Insurance Act emphasizes segregation of assets for protected cells in Section 581035, ensuring legal independence between cells. Question 2. Risk management and captive insurance. Which of the following is not typically considered an advantage of using a captive insurance company in a risk management strategy? A. Captives allow for more control over claims management and underwriting processes. B. Captives can provide the opportunity for tax benefits, including deductions for premiums paid. C. Captives provide protection from rate fluctuations in the commercial insurance market. D. Captives are fully exempt from state regulations and oversight, allowing for complete operational flexibility. Answer D. Explanation. One of the primary regulatory frameworks governing captives is oversight by state authorities such as the North Carolina Department of Insurance (NCDI). Captives must comply with both state and federal insurance laws, including financial reporting and solvency requirements. Thus, captives are not exempt from state regulations. Contrary to option D, North Carolina Captive Insurance Act requires captives to be licensed and regulated by the NCDI, and they must meet solvency and reporting standards. Question 3. Scenario-based question on captive formation. Mr. Davis, a business owner in North Carolina, is considering forming a captive insurance company to insure his company's liability risks. He has heard that his company can benefit from lower insurance premiums and better control over claims. However, Mr. Davis is unsure about the feasibility of this plan and the regulatory steps involved. Given his situation, what should Mr. Davis do next to move forward with forming a captive insurance company? A. Immediately proceed with the formation of the captive without any additional steps, as the benefits of captives are guaranteed. B. Conduct a feasibility study to evaluate the financial viability and potential benefits of a captive and consult with experts such as actuaries and captive managers. C. Rely solely on the advice of his existing commercial insurance provider without consulting any external specialists. D. Register the company under a different jurisdiction that has fewer regulations and lower startup costs. Answer B. Explanation. Mr. Davis should begin by conducting a feasibility study to assess the financial viability and potential benefits of forming a captive insurance company. This is a critical step in understanding the risks, capital requirements, and potential savings. Consulting with actuaries, captive managers, and other experts is essential to ensure the business meets all regulatory requirements and is set up properly. North Carolina Captive Insurance Act emphasizes the necessity of a feasibility study, which is required as part of the captive formation process. This step helps ensure the captive will meet the required capitalization and solvency standards outlined in the regulations. Question 4. North Carolina Captive Insurance Regulations. Which of the following is not a requirement for the licensing of a captive insurance company in North Carolina? A. The captive must meet the minimum capitalization requirements as outlined by the North Carolina Department of Insurance (NCDOI). B. The captive must submit an annual financial statement prepared by an independent auditor. C. The captive must have at least 3 independent board members, all of whom must reside in North Carolina. D. The captive must demonstrate the ability to pay claims by providing a detailed actuarial report. Answer C. Explanation. While North Carolina regulations require captives to have a board of directors, there is no mandate that all members must be residents of North Carolina. However, the board must be composed of individuals who are qualified to oversee the operations and financial health of the captive. North Carolina Captive Insurance Act requires the captive to meet certain capital and surplus requirements. Section 581045. Submit annual financial statements, Section 581050, and provide an actuarial report. However, it does not specify that the board members must reside in North Carolina. Question 5. Taxation of captive insurance. Which of the following statements regarding the taxation of captive insurance companies in North Carolina is correct? A. Captives in North Carolina are fully exempt from state premium taxes. B. The state imposes a premium tax on the gross premiums written by captives, and the rate varies based on the type of insurance written. C. Captives in North Carolina pay no federal taxes, as they are considered tax-exempt entities. D. Captives are not subject to any income tax but must pay a flat registration fee annually. Answer. B. Explanation. Captive insurance companies in North Carolina are subject to a state premium tax on the gross premiums they write. The tax rate can vary depending on the nature of the coverage provided, and captives are not exempt from state taxation. This helps ensure that captives contribute to the state's overall insurance regulatory framework. North Carolina Captive Insurance Act, Section 581080, sets forth the requirement for premium tax payments, which are calculated based on the amount of premiums written by the captive. Question 6. Reinsurance in captive insurance. What is the primary reason a captive insurance company would engage in reinsurance transactions? A. To transfer all of its underwriting risk to a third-party insurer. B. To ensure that it meets regulatory capital requirements set by the North Carolina Department of Insurance. C. To reduce the risk of insolvency by sharing potential losses with other insurers, thereby improving the financial stability of the captive. D. To increase its profitability by taking on more risk from unrelated companies. Answer. C. Explanation. Reinsurance allows captive insurance companies to manage their risk exposure by sharing potential losses with other insurers. This helps reduce the risk of insolvency and increases financial stability by diversifying the risk pool. Captives often use reinsurance as a tool for risk retention and to handle larger than expected claims. North Carolina Captive Insurance Act recognizes the importance of reinsurance in helping captives manage risks and meet solvency standards. Section 581045. Question 7. Legal and compliance considerations. Which of the following is a requirement for captives to maintain compliance with North Carolina's legal and regulatory framework? A. The captive must be audited annually by an independent auditor who is approved by the North Carolina Department of Insurance and NCDOI. B. Captives are allowed to operate without providing financial statements if they are in business for fewer than 2 years. C. Captives must submit quarterly solvency reports only if they have written over $100 million in premiums. D. Captives can operate without a risk management framework as long as they maintain sufficient reserves. Answer. A. Explanation. Under North Carolina regulations, captives are required to undergo an annual audit by an independent auditor approved by the NCDOI. This audit ensures that the captive's financial statements are accurate and that it complies with the solvency and other regulatory standards. Regular auditing is a critical aspect of maintaining regulatory compliance and financial stability. North Carolina Captive Insurance Act mandates regular financial reporting and audits to maintain compliance with solvency requirements. Section 581050. Question 8. Captive management. Which of the following is a key responsibility of a captive manager? A. They are solely responsible for managing the investments of the captive and selecting its portfolio. B. They manage the operations of the captive, ensuring compliance with regulations, assisting with claims management, and preparing financial reports. C. They act as the sole decision-makers for the board of directors and have final approval over all claims. D. They are responsible for issuing policies to third-party clients unrelated to the captive's owners. Answer. B. Explanation. Captive managers play a critical role in overseeing the daily operations of the captive insurance company, ensuring compliance with regulatory requirements, assisting with claims management, and preparing the financial reports. They are essential in the governance and operational functionality of the captive, but do not have full decision-making authority. North Carolina Captive Insurance Act recognizes the role of captive managers in ensuring the proper operation and regulatory compliance of the captive. Section 581035. Question 9. Emerging trends and challenges. How might captives help address the growing concern of cyber risk in modern insurance markets? A. By avoiding cyber risk altogether and only focusing on traditional physical asset protection. B. By pooling cyber risks from multiple businesses in a group captive and offering specialized cyber coverage. C. By transferring all cyber risk to a reinsurer and maintaining minimal coverage for cyber risks in the captive. D. By excluding cyber risks from all policies written by the captive to reduce the overall risk exposure. Answer: B. Explanation. Captives can address the growing concern of cyber risk by pooling cyber risks from multiple businesses, often through a group captive structure, and offering specialized cyber insurance coverage. This allows the captive to tailor policies to address specific cyber risks faced by its members while managing the risks collectively. North Carolina Captive Insurance Act and global trends in the industry support the expansion of captives to cover emerging risks such as cyber threats, helping businesses develop specialized risk management strategies. Question 10. Formation and structure of captive insurance. When forming a captive insurance company in North Carolina, which of the following is the most critical step to ensure its viability? A. Selecting a highly experienced captive manager who can oversee operations without external assistance. B. Completing a thorough feasibility study including financial analysis, risk assessment, and regulatory compliance review. C. Immediately obtaining reinsurance for all policies written even before the business is established. D. Choosing a fronting company with the least regulatory oversight to minimize initial costs. Answer: B. Explanation. The most critical step in forming a viable captive is conducting a thorough feasibility study. This includes assessing the financial stability of the business, identifying the specific risks to be covered, evaluating regulatory compliance, and understanding the capitalization requirements. A well-conducted feasibility study is essential for ensuring the long-term success and compliance of the captive. North Carolina Captive Insurance Act mandates a feasibility study before forming a captive to ensure its financial health and regulatory compliance. Section 581035. Question 11. Captive insurance licensing process. Which of the following is a requirement for obtaining a captive insurance license in North Carolina? A. The applicant must provide proof of a minimum amount of paid-in capital as required by the North Carolina Department of Insurance (NCDOI). B. The applicant must demonstrate that the captive will solely insure risks related to its parent company. C. The applicant must have a physical office located within the state of North Carolina. D. The applicant must submit a business plan that outlines the company's reinsurance strategy but not its underwriting guidelines. Answer: A. Explanation. One of the key requirements for obtaining a captive insurance license in North Carolina is meeting the minimum capitalization requirements as outlined by the North Carolina Department of Insurance. This ensures that the captive has enough financial strength to meet its obligations. North Carolina Captive Insurance Act, Section 581045 outlines the required capitalization for captive insurers. The requirements depend on the type of captive being formed, e.g., pure captive, group captive. Question 12. Reserve requirements for captive insurance. How does North Carolina regulate the reserve requirements for captive insurance companies? A. Captives are exempt from reserving because they are considered self-insured. B. Captives must maintain reserves in accordance with National Association of Insurance Commissioners (NAIC) standards. C. Reserves are not required for captives that only insure risks of the parent company. D. Captives must maintain a minimum reserve equal to the total amount of premiums they write each year. Answer: B. Explanation. North Carolina requires captives to maintain reserves in accordance with NAIC standards, which are designed to ensure that insurance companies have enough funds to cover future claims. These standards help assess the solvency and financial stability of the captive. North Carolina Captive Insurance Act, Section 581070 provides guidelines on how captives must maintain reserves based on recognized actuarial standards. Question 13. Solvency requirements for captive insurance. Which of the following statements about solvency requirements for captives in North Carolina is correct? A. Captives are not subject to solvency requirements as they are self-insured. B. North Carolina requires captives to submit quarterly solvency reports if their premiums exceed $50 million annually. C. North Carolina requires captives to demonstrate solvency through regular liquidity tests, even if their premiums are low. D. Captives must maintain a certain level of solvency, but the state does not require annual solvency reports. Answer: See explanation. North Carolina, like other states, requires captives to demonstrate solvency through regular liquidity tests. These tests ensure that the captive is financially able to meet its obligations, even in adverse situations. Regular solvency reporting is required to help regulators assess financial stability. North Carolina Captive Insurance Act, Section 581070 requires captives to meet solvency requirements, and this includes providing solvency reports to the NCDOI. Question 14. Investment restrictions for captive insurance. Which of the following is a restriction on the investment activities of a captive insurance company in North Carolina? A. Captives are prohibited from investing in real estate or equities. B. Captives must only invest in bonds issued by the state of North Carolina. C. Captives must invest conservatively, following guidelines similar to those for traditional insurance companies, but with more flexibility. D. Captives must invest all of their assets in short-term investments with maturities less than 12 months. Answer: C. Explanation. North Carolina requires captives to invest conservatively, typically following guidelines similar to those for traditional insurance companies. However, captives are allowed more flexibility in their investment strategies, often investing in a broader range of assets based on their risk appetite and financial goals. North Carolina Captive Insurance Act, Section 581065 provides guidelines on permissible investments for captives, requiring prudent investment strategies to ensure financial stability. Question 15. Captive Insurance Business Plan Requirements. Which of the following is a requirement when submitting a business plan for a captive insurance company in North Carolina? A. The business plan must outline the captive's plans for managing investments in non-insurance businesses. B. The business plan must include a detailed description of the risks to be covered and the types of insurance products to be offered. C. The business plan must be approved by an external audit firm before submission to the NCDOI. D. The business plan must demonstrate that the captive will not offer reinsurance or assume any external risk. Answer: B. Explanation. North Carolina requires captives to submit a business plan that includes a description of the risks to be covered, the types of insurance products the captive intends to offer, and the overall strategy for managing the business. The plan should also provide insight into the operational and financial structure of the captive. North Carolina Captive Insurance Act, Section 581035 outlines the business plan requirements for captives. Question 16. Captive Insurance Regulatory Oversight. Who is primarily responsible for regulating and overseeing captive insurance companies in North Carolina? A. The Federal Insurance Regulatory Agency, FINRA. B. The North Carolina Department of Insurance, NCDOI. C. The North Carolina Attorney General's Office. D. The North Carolina State Treasurer's Office. Answer: B. Explanation. The primary regulatory body overseeing captive insurance companies in North Carolina is the North Carolina Department of Insurance, NCDOI. This department is responsible for ensuring that captives operate in compliance with state laws and regulations. The North Carolina Captive Insurance Act establishes the NCDOI as the key authority for licensing, regulating, and overseeing captives operating in the state. Question 17. Group captives in North Carolina. Which of the following is a key feature of a group captive insurance company in North Carolina? A. It insures only one business or entity. B. It is owned by a single corporation and serves its subsidiaries. C. It is typically formed by a group of unrelated businesses that share common risks and objectives. D. It is not required to submit financial statements to the North Carolina Department of Insurance. Answer: C. Explanation. A group captive is formed by multiple unrelated businesses that come together to pool their risks and share the cost of insurance. This structure allows businesses to have more control over their insurance coverage while benefiting from shared risk. North Carolina Captive Insurance Act, Section 581035 provides details on the formation and regulatory requirements for group captives. Question 18. Reinsurance in captive insurance. Which of the following best describes the role of reinsurance in the context of a captive insurance company? A. Reinsurance is primarily used by captives to share the risk of underwriting losses and reduce volatility in their claims experience. B. Reinsurance is not typically used by captives as they retain all of their risk. C. Captives must reinsure all of their policies to reduce the amount of premiums written. D. Captives can only purchase reinsurance from North Carolina-based insurers. Answer A. Explanation. Reinsurance helps captives manage risk by transferring part of the underwriting risk to other insurers, thus reducing the financial volatility of claims. Captives often use reinsurance to help stabilize their financial position and ensure they have sufficient resources to cover large claims. North Carolina Captive Insurance Act allows captives to purchase reinsurance from both domestic and foreign insurers, subject to regulatory approval. Question 19. North Carolina Captive Insurance Exit Strategy. What is one of the key considerations for a captive insurance company when planning an exit strategy in North Carolina? A. The captive must continue operating for at least 10 years before considering an exit. B. The exit strategy must include the sale of the captive to a third-party insurer licensed in North Carolina. C. The captive must submit an exit plan to the NCDOI and demonstrate that it can fulfill all outstanding liabilities. D. The exit strategy requires the captive to dissolve immediately upon filing for dissolution. Answer C. Explanation. When a captive insurance company plans an exit, it must submit an exit plan to the North Carolina Department of Insurance (NCDOI). This plan must include provisions for meeting all outstanding liabilities, ensuring that the company can fulfill its obligations to policyholders and creditors before ceasing operations. North Carolina Captive Insurance Act Section 581090 outlines the steps for dissolving a captive and the regulatory requirements involved. Question 20. Changes to captive insurance laws in North Carolina. What impact does North Carolina's recent update to its captive insurance laws have on the formation of new captives? A. The updates require new captives to have a physical office in North Carolina to be licensed. B. The updates have made it easier for smaller businesses to form captives by lowering capital requirements. C. The updates require all captives to have a third-party reinsurer. D. The updates have increased the regulatory oversight and reporting requirements for captives. Answer B. Explanation. Recent updates to North Carolina's captive insurance laws have made it easier for smaller businesses to form captives by reducing the capital requirements for certain types of captives. This helps make captive insurance more accessible to a broader range of businesses. North Carolina Captive Insurance Act has evolved to accommodate a wider variety of business types, including small and medium-sized enterprises, by lowering some regulatory hurdles and capital requirements. Question 21. Types of captives in North Carolina. Which of the following types of captives is allowed under North Carolina law? A. Pure captive insurance company. B. Group captive insurance company. C. Risk retention group. D. All of the above. Answer D. Explanation. North Carolina law allows several types of captives, including pure captives, group captives, and risk retention groups. A pure captive insures only the risks of its parent company, while a group captive insures the risks of multiple businesses, and a risk retention group allows businesses to form a mutual insurance company to cover common liabilities. North Carolina Captive Insurance Act Sections 581020 through 581055 describes these captive structures. Question 22. Licensing of captives. What is required for a captive insurance company to obtain a license in North Carolina? A. Submission of a completed application and business plan to the North Carolina Department of Insurance (NCDOI). B. Proof that the captive has been in operation for at least 5 years. C. A guarantee from a licensed insurer that the captive will not incur any underwriting losses. D. All of the above. Answer A. Explanation. In order to obtain a license in North Carolina, a captive insurance company must submit a completed application along with a detailed business plan to the North Carolina Department of Insurance (NCDOI). The business plan must outline the types of risks to be insured, the financial structure, and the proposed reinsurance strategies. North Carolina Captive Insurance Act Section 581035 details the requirements for licensing captives. Question 23. Actuarial certification for captives. What role does an actuary play in the formation of a captive insurance company in North Carolina? A. The actuary must certify that the captive's capital is sufficient for its business operations. B. The actuary must provide an annual report on the captive's claims history. C. The actuary is required to provide a feasibility study and a financial projection. D. The actuary must approve all reinsurance contracts entered into by the captive. Answer C. Explanation. An actuary is required to provide a feasibility study and financial projection for the formation of a captive insurance company in North Carolina. This helps assess the viability of the captive, its ability to meet financial obligations, and its long-term sustainability. North Carolina Captive Insurance Act, Section 581035 requires actuarial involvement for business plan submissions. Question 24. Captive insurance taxation. How is a captive insurance company taxed in North Carolina? A. Captives are exempt from all state taxes. B. Captives are taxed at a higher rate than traditional insurance companies. C. Captives are taxed like other insurance companies, but with certain deductions available for premiums written. D. Captives are taxed based on the total amount of premiums written by the parent company. Answer: C. Explanation. Captives in North Carolina are generally taxed like traditional insurance companies, but they may receive certain deductions or benefits, such as tax credits for premiums written. The state's taxation of captives is intended to promote the development of the captive insurance market while still ensuring they meet state revenue needs. North Carolina Department of Revenue and North Carolina Captive Insurance Act detail the taxation process. Question 25. Reporting requirements for captives. What is required for a captive insurance company to maintain its license in North Carolina? A. An annual report of its financial status and a statement of its reserves. B. Proof of compliance with the North Carolina Insurance Code every 3 years. C. Only an annual payment of licensing fees to the North Carolina Department of Insurance, NCDO. D. A report on the investment portfolio, but only if the captive exceeds $10 million in assets. Answer: A. Explanation. To maintain its license, a captive must submit an annual report to the North Carolina Department of Insurance, NCDOI, that includes its financial status and a statement of reserves. These reports ensure that the captive is maintaining solvency and fulfilling its obligations. North Carolina Captive Insurance Act, Section 581075 details the reporting requirements for captives. Question 26. Captive insurance investment restrictions. Which of the following is a restriction on the investments that a captive insurance company can make in North Carolina? A. Captives cannot invest in real estate. B. Captives cannot invest in stocks or equities. C. Captives can only invest in short-term government bonds. D. Captives must invest in conservative assets but have flexibility regarding the specific types of investments. Answer: D. Explanation. North Carolina allows captives to invest in a variety of assets, provided that the investments are made conservatively. Captives have more flexibility compared to traditional insurers in terms of investment strategies, but they must still ensure that their investments align with their financial obligations and risks. North Carolina Captive Insurance Act, Section 581065 outlines the permissible types of investments for captives. Question 27. Captive insurance in North Carolina for risk retention groups. Which of the following is true regarding risk retention (RGS) in North Carolina? A. Risk retention groups must insure only the risks of their member organizations. B. Risk retention groups are exempt from all solvency and reserve requirements in North Carolina. C. Risk retention groups must operate within the state for at least 5 years before expanding to other states. D. Risk retention groups can only insure professional liability risks. Answer: A. Explanation. A risk retention group is a group of businesses that come together to pool their risks and cover liabilities that are commonly shared. The group must only insure the risks of its members, not external parties. North Carolina Captive Insurance Act, Section 581010 defines risk retention groups and their regulatory requirements. Question 28. Exemptions for smaller captives. Which of the following exemptions applies to smaller captives in North Carolina? A. Smaller captives are exempt from reserve and solvency requirements if they insure less than $1 million in premiums annually. B. Smaller captives can self-certify their financial reports rather than hire a third-party auditor. C. Captives with premiums under $2 million are exempt from certain reporting requirements. D. Smaller captives are not subject to any regulation from the North Carolina Department of Insurance. Answer: C. Explanation. Smaller captives with annual premiums under $2 million may be exempt from certain reporting and regulatory requirements, easing the burden on businesses that do not write significant amounts of business. However, they are still required to meet other basic regulatory standards. North Carolina Captive Insurance Act, Section 581040 allows for exemptions based on the size and scope of a captive's operations. Question 29. Captive insurance company mergers. What is a key consideration when merging two captive insurance companies in North Carolina? A. The newly merged captive must maintain the original capital levels of both companies. B. The merger must be approved by the North Carolina Department of Insurance and CDOI. C. Merged captives are required to be relicensed as a new entity. D. Mergers between captives are prohibited unless one of the captives has been in operation for at least 10 years. Answer: B. Explanation: any merger of captive insurance companies in North Carolina must be approved by the North Carolina Department of Insurance and SUDOI. The department reviews the financial and operational viability of the merged entity to ensure continued solvency and regulatory compliance. North Carolina Captive Insurance Act, Section 581085, outlines the process for the merger of captives. Question 30. Dissolution of captive insurance companies. Which of the following is required when a captive insurance company in North Carolina decides to dissolve? A. The captive must liquidate all of its assets and distribute the proceeds to its shareholders. B. The captive must submit a dissolution plan to the North Carolina Department of Insurance and demonstrate that all outstanding liabilities will be covered. C. Dissolution is automatic after 3 years of inactivity. D. The captive must continue operating for at least 1 year after filing for dissolution to allow for claims to be processed. Answer: B. Explanation: when a captive insurance company in North Carolina decides to dissolve, it must submit a dissolution plan to the North Carolina Department of Insurance (NCDOI). This plan must show that all outstanding liabilities, including claims, will be fully covered before the company can officially dissolve. North Carolina Captive Insurance Act, Section 581090, governs the dissolution process for captives.